David R. Guttery is the Chief Executive Officer of Keystone Financial Group in Trussville, Alabama. David Guttery and Seth Edgell are financial advisors who represent Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by David Guttery, CEO of Keystone Financial Group, to share his thoughts about the economic outlook for 2026. David, thanks so much for being with us today. You have said within previous videos that sometimes things are not always as they seem, and that people should not be satisfied with superficial observations. You have encouraged our viewers to insulate themselves from sensational noise, especially when it comes to the management of portfolios. Today, I believe you're going to share with us your thoughts about the economy, both now and as we emerge into the new year. In your opinion, are we once again confronted with a reality that may be different from superficial appearances?
Before we get started, just a little compliance housekeeping. The economic forecasts set forth in this material may not develop as predicted and are subject to change. Investing always involves risk, including the possible loss of principal. To answer your question, yes, in my opinion, that is exactly the situation within which we find ourselves. Throughout the year, there has been much media-based conjecture as to whether or not tariffs would incent geopolitical and geoeconomic outcomes, or whether they would act more as a tax, resulting in the recession of our economy. As the market was capitulating in the first quarter, I believe that market participants feared a deep and long global recession event that seemingly hasn't materialized. Indeed, I would argue that the economy has fared significantly better than what the average person might have imagined just 8 months ago. And only now are we able to quantify those metrics on a spreadsheet. Today, I want to discuss some of those quantifiable metrics in light of discerning between fear, speculation, and the reality that seems to suggest we are pursuing a much better and different outcome. In particular, I can make a case that industrial production is expanding rapidly. And this has recently been evidenced by the surprise 4.3% increase in gross domestic product and the degree by which our exports are seemingly rising. Personal consumption has also seemingly been much stronger than we might have anticipated earlier in the year. And I believe that stands as testament to the overall strength of the U.S. household. I believe this will manifest in better employment metrics throughout the year, incentivized by the Federal Reserve, and the posture that arguably hasn't been this lucrative since 1988. Indeed, in my opinion, when you compare the year of 2017 with that of 2025, it appears to be a very similar overlay. And frankly, I think that the economic rebound activity is happening at a faster rate today than it did back then. Should that prove to be the case, then, in my opinion, I believe that we can expect better economic metrics in 2026 than we did in 2018. Now, that's encouraging because as of February of the year 2019, 7 economic metrics hit all-time record highs that, as of today, have yet to be eclipsed. We may have a repeat of that economic outcome in our future.
Well, David, that certainly sounds encouraging. Why don't we unpack these metrics one at a time? Figures may be better throughout the coming year. Can you share with our viewers why you are left with that opinion? Because that would certainly be a critical piece to any potential economic expansion.
Absolutely. First, let me draw a reference to the Federal Reserve Board. On the 1st of July in 2025, within a global banking forum, Chairman Powell was asked about the disposition of the Federal Reserve, and he quipped, "What do you do when there's fog on the road? Slow down." As of midsummer, there remained much ambiguity as it pertained to the aggressive tariff strategy being employed by President Trump. And as a result, the Federal Reserve was reluctant to acquiesce accommodation as it pertained to monetary policy, in spite of Chairman Powell's suggestion that the federal funds rate remained 100 basis points above what he would call a neutral rate. As late as August, however, at the annual meeting of the Federal Reserve in Jackson Hole, Wyoming, Chairman Powell seemingly had changed his stance when he suggested that the Federal Reserve could be more forward-looking in the adjudication of monetary policy. Sure enough, since then we've had 3 rate cuts. To me, this implies that the Federal Reserve is much more comfortable today than just 6 months ago with what they can discern regarding the president's tariff strategy and the potential for higher inflation. Getting back to private employers, if I make this widget and many of my inputs are sourced from foreign vendors, then I really haven't been certain of my potential profit margin over the last several months as a function of tariffs. In my opinion, there is ample evidence to suggest that you are demanding more of these in greater quantities, but strangely, we have not seen the follow-through that we would expect as it pertains to employment and capacity utilization. Until now, it would appear that we are keeping up with demand without increased overhead in the form of capacity utilization and employees. My question is, how much longer can that persist? Think of a balloon. It has a limited capacity of air before it will burst. In my opinion, I sense that we are at the capacity of our ability to make things. And at some point, private employers must relent to the greater pressure that comes with demand in order to keep up with hiring, so that we can keep up with demand in the future. If the Federal Reserve is seemingly more comfortable with the president's tariff strategy, then I wonder how closely behind private payrolls might also be. From this chart obtained from Bloomberg and sourced from the Federal Reserve, it appears that global financial conditions haven't been this lucrative in a very long time, and arguably not since 1988. That is a function of not only the Federal Reserve being accommodative, but also global central banks across the world. Lending conditions, in other words, are as lucrative as they have been in a while. If I'm a manufacturer faced with the choice of expanding my capacity to make things or losing that demand to competitors, then it seems this would be a very advantageous time to leverage assets for the expansion of plants, the acquisition of equipment, and the hiring of additional labor capital. Another metric that just isn't getting much press lately is weekly jobless claims. These have seemingly dropped sharply just since Labor Day. Historically, this has been regarded as a positive, forward-looking indication that payroll creation could be positive in the future. So again, I can't make any guarantees, but what we saw, very similar trends in the transition year between 2017 and 2018, when employment became strongly positive and was seemingly aided by an accommodative Fed as the economy was expanding and industrial production was expanding. For these reasons, I feel very optimistic about the direction of employment in the coming year. Economically, if more people have more money to spend, then obviously that would enhance the velocity of money, which we observed hitting an all-time record high in February of 2019. As you have more money, you buy more things. Those manufacturers are incentivized to make more things to replace them on the shelf, and thus the positive feedback loop. And very often, it begins with employment. And right now, we are early with these observations, but in my opinion, this is a metric that could be surprisingly strong in 2026.
Well, David, that does sound very encouraging. This sounds like a data point upon which we will remain focused throughout the coming year. You mentioned that industrial production could be a driver behind positive employment metrics. What are you observing that leaves you with a positive impression about consumer demand and the state of the industrial economy?
Great question. First, the ISM Manufacturing Index is a broad and high-level glance at the strength or weakness on the industrial side of the economy. Any reading above 50 indicates expansion, while any reading below 50 indicates contraction. In November, we observed the fastest expansion of the ISM Manufacturing Index that we had seen in 3 years. Simultaneously, we learned that exports are much higher as well, and I believe this is being driven by new trade agreements recently signed throughout the year with other countries and incentivized by the President's approach to his tariffing strategy. Before Christmas, we learned that the United States gross domestic product expanded by 4.3%, which was clearly unexpected and surpassed the expectations of most economists. Indeed, some in the business media were literally lost for words when that news crossed the wire. Now, this didn't come as much of a shock to me, however, because I've been watching metrics like the Bloomberg Surprise Index. This is a composite index shaped by many individual economic observations. Throughout the year, I've watched this index increase sharply, and that too is a good way to cross-check other industrial readings. I mentioned that U.S. industrial production was near an all-time record high, and all of these metrics, when viewed collectively, suggest to me that the consumer is demanding increasingly greater quantities of widgets. To this point, it would appear that we are meeting that demand without a corresponding increase in the employment that you might otherwise expect, but I believe that's on the radar screen for the coming year, as we were discussing earlier. Again, regarding the ISM Manufacturing Index, looking at this historical graph of the index, observe the year 2016 as we emerged into 2017. At that point, we were also coalescing around a near-term bottom. That by February of 2019 resulted in the highest reading that we had seen on that index. The one dot plot at 65 following the recession of 2020 is an outlier, in my opinion, and can be discounted due to the reopening of a pandemic-induced closure of the economy. The point is that we are once again seemingly coalescing around a near-term bottom, as very encouraging metrics are beginning to suggest that we may once again be headed toward expansion, and with it, a greater demand for employment.
Well, David, that makes sense, but I want to ask for your thoughts regarding the strength of the consumer that is seemingly behind the increasingly greater demand for goods and services. In your opinion, is the U.S. household really in a good and strong purchasing disposition, or are households turning to increasingly greater use of credit cards, for example? Is this sustainable because income is rising, or is this simply being driven by exorbitant use of credit?
Yet another great question. And yes, that is certainly something about which we need greater clarity if we are going to feel confident about the direction of the economy. The first graphic to which I would like to draw reference comes from the Federal Reserve Bank of Atlanta. It overlays real median household income in the United States with the sticky price consumer index, less food and energy. Over the last 3 years, you can see a discernible and widening gap between household income and the rate of inflationary change. That gap is our increasingly greater ability to buy goods and services. Now, some may argue that the inflation metrics we're getting from the government are not reliable, and I beg to differ. This is the same calculation coming from the same source that we have had from every presidential administration across most of our lifetimes. Whether we're talking about eggs, cheese, milk, or gasoline, we can see that prices are indeed coming down. And I would argue that gasoline is having a positive impact on food inflation as well. Everything that you just purchased at the grocery store spent some time on a truck. The farmer had to run the tractor twice to plant the corn and then harvest the corn before it was loaded onto a truck to be shipped to a processing plant and made into corn flakes, where it was then loaded on yet another truck to ship to your local grocery store. Gasoline is down almost 30% over the last year, according to GasBuddy.com, and it is currently under $3 per gallon in 38 of the 50 states in America. The most recent CPI shows the lowest rate that we have observed since the year 2021. Incomes are rising. The rate of inflationary change is falling. The widening gap between those two metrics is our increasingly greater capacity to purchase goods and services. So I would argue that improving metrics of consumption are being driven more by income than use of credit. And therefore, yes, I believe this is a sustainable trend that hopefully gains additional traction in the coming year. I will share this graphic that I obtained from J.P. Morgan and sourced from the Federal Reserve Board. At the end of the third quarter, the average ratio of assets to liabilities for the U.S. household had not been this healthy since at least 1960, according to this graphic. At least according to metrics like this, I am not left with the impression that the average U.S. household is on the brink of collapse under the weight of its own debt. To me, data like this implies that the average household in the U.S. hasn't been this healthy in decades. And again, seems to confirm my belief that the economy could expand in a very positive way and as early as next year.
Well, David, you have certainly supported a very strong case for why the economy could prosper in the coming year. I'm sure that all of our viewers hope that you are correct. And in closing, what final thoughts could you share that ties all of this together with financial planning and investment management?
As I've said in the past, at all times, people should be more concerned about the horizon than their shoe tops. Be more focused on the fruition of long-term planning goals, more so than the patch of ground upon which you're standing at the present time. When you can do that, you have greater intestinal fortitude to weather periods of time that we experienced earlier this year. According to CNN's Fear and Greed Index, as of the 4th of April, fear was rampant. Now, I mentioned this in a video earlier in this year too. After 34 years, I have never seen a 4 on this index. I mean, the metric only goes to 0. So I had to question what flavor of economic Armageddon was the market anticipating. During that 8-week period of time, the market shed over 21% in value, and that was the deepest drawdown that we had seen over any rolling 8-week period of time in 100 years. Just 90 days later, however, that same Fear and Greed Index showed quite the reversal of opinion. Welcome to my world of sentiment whiplash. The only way to prosper through a period of time such as this is to be more focused on the fruition of planning goals than the latest sensationalized media spin on the crisis at hand. Warren Buffett has often talked about being greedy when others are fearful. Well, in my opinion, we had that opportunity earlier this year. I would encourage everyone to work with a financial professional who can help them navigate periods of time like this stoically. When I am embarking on any analytical exercise, I am not a Republican, I'm not a Democrat, I'm not an Alabama fan, I'm not a three-toed tree sloth. I go into any analytical exercise with an agnostic and blank mind. Is the answer yes or no? Let's examine data and find that out. Only then can data truly speak to you, and then you must have the intestinal fortitude to follow those convictions. So again, I can't make guarantees here, but it seems to me anyway that we may be on the precipice of experiencing another economic period of time like we did between 2018 and when the COVID pandemic resulted in the shutdown of our economy. Assuming no new pandemic level events or geopolitical crisis events, we may be on the doorstep of yet another robust and expanding economy.
Well, David, as always, thank you so much for this information. And for additional information, David may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brannon Dawkins.
David Guttery and Seth Edgell independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segments is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.